Hello business owners and entrepreneurs, my name's Aaron March and in this video we're going to answer 3 questions. What are franking credits? What is a franking credit refund? And what is top-up tax? In my view, franking credits are one of those beautiful parts of the Australian tax system and I hope this video helps explain why. Okay, so it's been a big year down at the ranch and Yellowstone has made a profit of $1 million. Their tax rate is going to be 25%, giving them a tax bill of $250,000, leaving them with $750,000 of retained earnings to pay dividends to their shareholders with. Now, importantly, for each dollar of tax that the company pays, they're going to receive a franking credit, and that's going to sit in the company's franking account. And I'll show you the benefit of these later in the video. A good way to learn about franking credits is to see what would happen if there weren't any. So let's consider a scenario where there aren't any franking credits and Yellowstone pays out their full retained earnings of $750,000 to an individual. So the individual in their tax return would show a dividend of $750,000 and then pay tax on the same amount. That would give them a tax bill of $320,000. So it's a pretty big bill. What that means is for the individual, they will only have cash left at the end of $430,000. What you can see here is that there's double taxation. The $1 million first get taxed here at in the company and they pay $250,000. They then get taxed again in the individual's name at $320,000, bringing the total tax payable to $570,000, leaving just $430,000 left over at an abysmal tax rate of 57%. Now let's consider what happens when there are franking credits. Okay, same scenario, Yellowstone pays out a $750,000 dividend. So again, the individual in their tax return will put in $750,000. And again, that's the cash that they'll receive for the dividend. But now they also include the franking credits. So in their taxable income, they will gross this up to be $250,000. And now their taxable income comes to $1 million, which you'll notice the $1 million is the same as the $1 million that the company paid tax on. Now the tax bill for an individual on $1 million is $440,000. And here is the real beauty of the franking credit. Because what happens is that $440,000 is reduced by the amount of the franking credits. So that comes, you take off $250,000, leaving a payable of $190,000. Now I'm going to quickly show you what would have happened if Yellowstone had have taken that $1 million and paid it to John as a wage, right? What would have happened there? In Yellowstone, the profit goes down to nil, so they don't pay any tax. So they've got nil tax. Now, what would happen in the individual's name, or John, he would have taxable income of $1 million. But that would come through as a salary and wage, right? Then he would get a tax bill of $440,000. He would pay the full amount because he's not getting any franking credits anymore coming through from dividends. So that goes to nil. So he would pay $440,000, also having $560,000. You can see that in the fullness of time, there's not much difference between using a fully franked dividend and a salary and wage. Unless, of course, you do have a company that's got a large franking credit balance, then you can get a pretty big cash flow advantage by using your prepaid tax, which is your franking credits, to fund your personal tax liabilities, as opposed to using new money via PAYG withholding. Okay, so now we're going to have a look at some examples that explain what is top-up tax and what is a franking credit refund. Okay, so what we've got here, we've got 3 different scenarios. We've got Beth, Rip, and John. Now, all of them are the same. They all get a $75,000 dividend, which comes with a $25,000 franking credit, which results in taxable income of $100,000. The only difference between these 3 is their tax rates. Beth's is 47, Rip 25, and John is nil. Okay, so if we go through this, I'll just show you how the maths works out. So what's going to happen is Beth has got taxable income of 100, her rate is 47. She's going to get a tax bill of $47,000. However, she'll get the benefit of her franking credit, which is worth $25,000, which gives her an amount payable of $22,000. So this is a scenario where Beth has got what we call top-up tax. She has received a franked dividend, and because her tax rate is 47%, is higher than the franking credit rate or the company tax rate of 25%, when she receives a franking credit, she has to pay more tax or top-up tax. And so if we have a look at this, she receives is $75 or $75,000. However, she's got to pay an extra tax of $22,000. So the top-up tax rate here is 29%. Now let's have a look at Rip. Rip is the same. He's received the $75,000 dividends with the franking credits. He's got a tax week of $100,000, but his tax rate is only 25%. So his tax payable is $25,000. However, Rip has got franking credit also of $25,000. So that comes off the payable, which means that he's got nil to pay by receiving this dividend because his tax is funded by the franking credits. Now let's have a look at John. So again, he's exactly the same. His tax rate is nil, and so that means his tax bill is nil. He's received the $25,000 in franking credits, so that's negative 25. That comes down here. So his payable is actually a refund. So he's actually going to get a refund of the franking credits that Yellowstone paid earlier because his tax rate is nil. Okay, so he will actually get a refund of $25,000. Okay, and so you can see sometimes you hear about the franking credit refunds in the news because you can feel like it's money coming back out of tax that's already been paid. So you might be thinking, how can John have a 0% tax rate? Well, once the super fund goes into pension mode, the tax rate's nil, and this is a common occurrence, then this is how people are getting franking credit refunds. What you can see here, if a person has got a tax rate that's lower than the franking credit rate, they're going to receive a franking credit refund. However, if your tax rate is higher than the franking credit rate, you're going to receive a top-up tax bill. So in wrapping up, we've learned that a franking credit is tax that's been paid by a company that can attach to a dividend to reduce the tax bill of whoever receives the dividend. We've also learned that the franking system is a beautiful part of the tax system because it reduces double taxation. And finally, we learned that dividends can result in a top-up tax liability or a franking credit refund dependent on the tax rate of who receives the dividend. Thanks for joining in this video, and hope to see you in the next one. John Dutton's looking pretty old. I hope he's got his estate plan up to date.